So let's now talk about adjusting accounts and preparing financial statements. Up until this time, we've been talking about the accounting cycle. And we've been talking about the accounting cycle where at the beginning, we have a financial transaction that we analyze. We analyze that financial transaction and we record it into the journal, which is a chronological listing of how our transaction has affected our accounting equation. Once we've done that, where we've recorded it in chronological order, then we post the transaction into the ledger in account order, in other words, by classification, so that we can then take all the transactions for the period and summarize it so we can identify how all the transactions for the period have affected the accounting equation in total. After the posting to the ledger and we've summarized and totaled up all the increases and decreases to the various financial accounts in our accounting system, we then create a trial balance which makes sure that our debits equal our credits. Remember, in our T account, the debit is on the left side of the T and the credit is on the right side of the T. What this chapter is now going to do is to complete this accounting cycle by talking about adjustments before we create the financial statements, and then after we create the financial statements, we close the books by creating a series of accounting journal entries. So now let's talk about why do we adjust the books. There's pretty much three reasons why we adjust the accounts in our accounting records. First of all, we adjust our accounts in our accounting records because we want to accrue or defer the recognition of revenues or expenses into the correct accounting period. The second one is to record the adjustments to previously accrued or deferred items. And then the last one is to close the books for the period. What we mean by to accrue or defer the recognition of revenues or expenses into the correct accounting period has to do with the difference in the timing of the recognition of revenue and expenses to the actual cash activity. Now, as individuals, we're used to the cash activity being when we recognize revenues and expenses in our personal lives, because when we receive cash, we consider that we've received revenues. But because of the accrual basis of accounting, we do not recognize revenues when we receive the cash, but rather we recognize revenues when we earn the revenue through either the provision of services or the providing of a product to our customer. The expense on the other side is recognized when we incur the benefit of the transaction, and that what we've done is that we want to match it using the matching principle to the revenue in the same period. Now, many times that happens, cash may not have occurred. For instance, if I went and I bought product or received a service from a vendor, but I haven't paid them yet, I've received the benefit of the service or received the product, but I haven't paid out cash. But because I received the service or the product, I've had the benefit, so therefore it is an expense in the period in which we receive that benefit. On the other side, on the revenue recognition, we recognize revenues when we receive the revenues. So if we receive the cash in advance, but we haven't provided the service or the product, we haven't earned the revenue, so therefore we have a liability which says we are obligated to provide a service or provide product to that customer because we received the cash. On the other hand, if we receive the product or we sold a product, or if we provided a service to a customer and we haven't received cash yet, we need to make sure that we recognize the revenues when we did the work so that we have it in the right accounting period. So therefore, in both these situations of accrual or deferral, we have to recognize the revenue expense in the correct period. In some cases, there are no source documents to support the transaction, so therefore we have to actually examine what's happened towards the end of an accounting period to determine of whether we need to make an adjustment or not. Another reason why we need to adjust the accounts is to record adjustments to previously accrued or deferred items. For instance, if we prepaid for a service from a vendor, and such as, for example, insurance, where we had an account called prepaid insurance, our usage of that insurance policy for a period is where we've incurred the benefit of using that insurance. So what happens then is if I have a 12-month insurance policy, each month I use up 1 month's worth of insurance. Now there is no source document that says we used up 1 month, but if I know that we've had a 12-month policy and we're going from month to month to month, each month we would recognize 1/12 of that 12-month policy. No source document, but we need to make an adjusting journal entry so that it reflects that we had the benefit for a 1 month of usage. So that's kind of things that we have to do when we have to adjust. Also, some other things that we might have to adjust is if we have a balance in our accounting records, we might need to make an adjustment to an account to reflect the usage of items within that account that we have not recognized yet at the end of the period. For instance, if we had office supplies, we may have a balance in our office supplies account because we've purchased office supplies over the period, but we don't know how much we actually have until we at the end of the period where we actually go and physically count what's in the office supplies, and so that we have to adjust our accounting records to actually reflect what actually is present in our office for our office supplies. So we would have to make an adjusting journal entry. The last thing we have to do to make adjustment is to close the books. Now, to close the books, what we have to do is when we look at our chart of accounts, we need to identify which accounts are temporary accounts and which accounts are permanent accounts. Now, temporary accounts are the accounts that we need to recognize that we need to start fresh or start at zero at the beginning of every period so that as we accumulate the transaction activity in the account, we will know exactly how much is being done in that period and not reflected in other periods. An example of that would be like a revenue account or an expense account. If we did not close out the revenue account or expense account each period, the transactions would continue to accumulate from period to period, and we wouldn't have the ability to see what we did each period in terms of revenues and expenses. So therefore, at the end of the month, we have to close out our books. So if we look at the 4 steps to close the accounts, the first one says close your revenue accounts to the income summary. So if I have a revenue account whose normal balance is a credit balance, what we'd have to do is we have to zero out that credit balance account to 0 by doing a debit journal entry to the revenue account. The corresponding credit would be to this account called income summary. Now, income summary is a temporary account that if we use it properly at the end of every closing should also zero out because it is a temporary account and accordingly should be zeroed by the end of the period. Step number 2 says, let's zero out the expense accounts to the income summary. Expense accounts on the income statement, normal balances are debits. So if we have a debit balance in our expense account, in order to zero it out, we'd have to do a corresponding credit to zero it out, and the corresponding debit to that credit entry would be to income summary. So what we have then is that an income summary account, if we had a T account, the T account to the income summary, the credit entry would be the total revenues, the debit entry would be the total expenses, and the difference between the two, net income, would be the balance prior to the third closing journal entry we have to make, which is to zero out the income summary into retained earnings. If you recall, in the prior chapters, we talked about the formula for retained earnings, where we said beginning retained earnings plus net income minus dividends equals ending retained earnings. So this entry number 3, where we close out the income summary to retain earnings, is the plus net income portion of that little formula we did to determine what retained earnings is at the end of the period. The 4th journal entry is to close out the dividends account to retain earnings. So this is the second adjustment we have to make to retain earnings. So dividends being a debit balance account in the equity section of the balance sheet, we would have to zero it out with a credit journal entry to the dividends account in order to zero it out. Since we're going to do a credit to the dividends T account, we would have to do a debit to the retained earnings T account. Now, retained earnings, normal balance, is a credit balance, so the adjustment that we made in step 3, where we zeroed out the income summary account, would be an increase to retained earnings, the plus net income, and the debit entry in the retained earnings adjustment for the dividends would decrease retained earnings. Once we've done these 4 steps of closing the revenues, closing the expenses, closing the income summary, and then finally closing the dividends accounts, we would have zeroed out all our temporary accounts so that we could go ahead and start our books and records for the next accounting period. So let's go ahead and let's take a look at some problems. Problem 3.4a is a comprehensive problem that takes you from the beginning of the accounting period to recording all the transactions that are being incurred for the period of April of 2008. After we've done the initial transactions that we've recorded from April 1st through April 30th, the problem requests us to now do the journal entries, post it to the ledger to get to the trial balance. From the trial balance, then we need to do the adjustments, which is in requirement 4. From doing the requirements for journal entries, then what we'd have to do is then post those also to the ledger, and then in turn, from the ledger and the trial balance, we could create the financial statements. Now, I'm not going to do the entire problem for you, but what I would like to do with you is the journal entries and the posting to the trial balance so that we can take it all the way to closing of the books. I will leave for you the creation of the financial statements, because once you have the T accounts that we're going to show here on the right, you'll be able to create your own financial statements and your own trial balance as well. So let's start this out. According to this problem, on April 1st, 2008, Jiro Nozumi created a new travel agency, Adventure Travel. The following transactions occurred during the company's first month. And what we have here is from April 1st through April 30th, a series of transactions that were made. What the problem asks us to do is to record the journal entries that we would have to make for each one of these transactions. Now, they helped us out here by giving us a chart of accounts to work with, which is right below here. And these accounts here of account 101 for cash all the way to account 901, which is the income summary, are the accounts so that we can consistently apply these transactions to the correct accounts. So let's try that. So we read on the first one, it says Nozumi invested $30,000 cash and computer equipment worth $20,000 in the business in exchange for its common stock. So what we would have to do is do a journal entry. And that journal entry first says, what do we do with the cash? We received $30,000 cash and the cash went up. So therefore, because cash is an asset, we would have to record a journal entry to cash, and it would be an increase to cash of $30,000, or because cash is an asset, the normal balance for cash would be a debit. The second part of this problem says that the computer equipment of $20,000 was also received. Now, computer equipment is also an asset, so we would have to do a debit to computer equipment. for the value of the equipment that was being transferred, or $20,000, and in exchange for the $30,000 in cash and to the computer equipment, Nizumi received stock. So we would take common stock and we would credit that for $50,000. So now we have our debit entries and credit entries all agreeing. Now, if we were doing this in our real general journal, we would want to put a description down here to kind of tell people what that transaction is. But because of space, we're going to go ahead and leave out the descriptions. On April 2nd, they rented an office space paying $1,800 in cash for the first month, April's rent. So $1,800 in cash went out, so cash went down. So therefore, we're going to do a credit entry to cash, and cash went down by $1,800. So we're going to do a credit entry. On the debit side, because this is only for 1 month's rent for the month of April, it's not a prepaid because it's not going to be spent over multiple months. It's just for 1 month. So, and it's for the current month. So we need to recognize it for the month of April. So let's go ahead and let's place this to the account as we have there called rent expense. Notice what I'm doing here is I'm taking the account titles straight from over here, which is from our chart of accounts. So we're being consistent in that we're always using the same account names for every transaction we do. The next transaction on April 3rd says we purchased $1,000 of office supplies for cash. Now remember, office supplies is one of those things that we're not going to use it all at once. It's probably going to be used over a period of time. So in essence, when we're buying office supplies, we're prepaying for that office supplies, and that is an asset. So we're going to debit this, since an asset is a debit-based account. And we're going to increase it by how much we paid for it, which was $1,000. According to this problem, we paid cash for it, so therefore cash is going to go down. So we're going to do a credit entry to cash, and we're going to decrease it by doing a credit entry. Next, on the 10th, we paid $2,400 in cash for the premium on a 12-month insurance policy. Coverage begins on April 11th. Since this policy is going to be good for 12 months, we know we're paying in advance, and because we're paying in advance for 12 months worth of insurance, we need to spread the cost of this $2,400 over the 12-month period. So what we're going to do is we're going to show that cash went down by $2,400, but we got a new asset called prepaid insurance for $2,400, and because we paid cash for it, we're going to decrease cash with a credit entry of $2,400. The next entry, on the 14th, we paid $1,600 in cash for 2 weeks' salaries earned by the employees. Now, the employees did the work, so therefore, we have received the benefit, so we have to recognize the expense. So if we look for an account here called salaries expense, we're going to debit salaries expense. And the dollar amount is for $2,400. We paid cash for it, so we're going to decrease cash by $2,400. The next entry on the 24th, we collected $8,000 in cash on commissions from airlines on tickets obtained for our customers. So what would happen here is that cash went up. So we're going to debit cash, and we're going to put this on the debit side for $8,000. And we're going to find a revenue account in our chart of accounts here called commissions earned. And that's going to be a credit entry to $8,000. And the reason why we're going to do a credit, because a revenue account's normal balance are credits. In other words, when we do a credit entry to a revenue account, it's going to increase the account balance. Next, on the 28th, we paid another $1,600 in cash for 2 weeks' salaries earned by our employees. So, once again, salaries expense for $1,600. We paid cash for it. So cash is going to go down by $1,600. The next entry, we paid $350 cash for minor repairs to the company's computers. We look for an account in our chart of accounts over here called repairs expense. Since we got the benefit of the service in the month of April, we need to recognize the expense. So we're going to debit repairs expense for the $350. There we go. And according to this problem, it says we paid cash for it. So once again, we're going to decrease cash by $350. On the 30th, we paid $750 in cash for the telephone bill. We have an account down here, account 688, called telephone expense. So we're going to debit telephone expense. And it's for $750. We paid cash for it. So that's a credit because we're going to decrease our cash account. And then we're going to go over here. The last one, we paid $1,500 cash for dividends. So dividends increases with debits. So we're going to go over here and we're going to put $1,500 in the dividends. And we paid cash for it, so we're going to decrease cash by $1,500. So now what we have here is we've done the month's transactions, we've done the journal entries, and now what we have to do is we need to post this to our general ledger. Now I'm going to move my screen over here a little bit so we can see the journal entries and our T accounts as best we can here. So what we need to do now is take our journal entries, our debits and credits, post them into our ledgers, and the ledgers are being represented by these T's. Remember, each one of these T's is a separate page or a separate account that we need to keep track the increases versus the decreases of our accounts. So you have to remember which side of the T's are the increased sides and the decreased sides. For assets, the increased sides are debits, the decreased sides are credits. For liabilities, the increased side is a credit, the decreased side is a debit. For equity is the same way. The increased side is a credit, the decreased side is a debit. So let's go ahead and let's post these up because we did the journal entries. So the first one we have here is cash of $30,000. So we're going to put the $30,000 that's equivalent to this entry here. We're going to stick it here for $30,000. The next entry over here for a debit to computer equipment, I take it down to my computer equipment line here. It's for $20,000. And then what we did here is common stock for $50,000. It's a credit entry, so put it over here, $50,000. Next, our rent expense, which I'm missing a number here, for $1,800. So rent expense over here, $1,800. And we use cash for $1,800. Next, our office supplies. This is an asset account, so we're going to put office supplies. Oh, we don't have a T account for office supplies. So what we have to do is create one. Let's write one up here. So I'm going to go ahead and do this real quick, and then we'll restart this. Okay, now that I've set up that office supplies T account that I forgot to put in here for us, let's go ahead and post up this office supplies. So we have a debit of $1,000 into the office supplies asset account, which is a debit entry, and a credit to cash for $1,000 over here. on our T account to decrease the cash. The next one is the prepaid insurance account. We're going to increase prepaid insurance over here for $2,400. And we paid cash for it, so we're going to decrease cash by $2,400. Next one here, we received $8,000 in cash for commissions earned. Cash is going to go up by $8,000. And commissions earned. And the commissions earned account over here is our income statement account for $8,000. Credit. Next, our salaries expense of $1,600. Salaries expense on the expense goes up with a debit, so we're going to debit $1,600. And we paid cash for it, so cash is going to go down by $1,600. Next, our repairs expense here. We're going to debit the repairs expense account by $350. I should have a repairs expense account somewhere over here, so let's take a look. There it is, $350. We'll go back here so we can see it again. And then let's get it nice and so we can all see the transactions. Next, telephone expense, $750. That's right here. That's $750. And cash. Oops, we forgot the other one here. Repairs of $350. And now we do the telephone of $750. And the last one is the dividends. Dividends of $1,500, cash $1,500, so cash is going to go down by $1,500. Credit, the dividends account, which is right here, is going to go up by $1,500. So what we've done here is now we've posted all the transactions that are here from the original transactions, and then what we've done is we've gone over here and we've posted it into our ledgers on both the debit and the credit side of the entries. At this point, what we could have done is we could have taken a total, found the difference between the debit and the credit entries so that we would have a running balance before our adjustments so we could create an unadjusted trial balance. We did that in Chapter 2, so I'm going to leave that for you. And we're going to just continue on to the next part, which are the adjustments. Because remember, in our accounting cycle, now that we've created the unadjusted trial balance, we need to create the adjustments so that we can adjust these accounts to create the financial statements. So let's take a look over here in Requirement 4. In Requirement 4, it says, use the following information to journalize and post your adjusting entries for the month. It says, round to the nearest dollar amounts and omit the dollar signs. So if we do here from the adjustment, it says 2/3 of 1 month's insurance coverage has expired. So if I look at my insurance coverage up here, it was $2,400 for a 12-month insurance policy. So a 12-month insurance policy, so if I take $2,400 divided by 12, I should recognize $200 per month in insurance. What it says here is that 2/3 of 1 month's insurance. So if I take my 200 and take 2/3 of it, I'm going to get $133.33. So what I need to do, and it says round your answers to the nearest dollar amount, so we're going to just say an even $133. So our adjusting journal entry is going to be debit to insurance expense. Now remember, the expense account says that we receive the benefit of the use of that asset. So when we use up our prepaid insurance, as we did up here, where we created it, when we recognize that we use that prepaid insurance, when we use an asset, we get an expense. So we're going to debit insurance expense for $133, which once again, it's the $2,400 for 12 months divided by 12 to give you your monthly, and then take 2/3 of it because it says that 2/3 of 1 month is expired for the period. If we recognize that we've gotten the benefit of 2/3 of 1 month, we also have to reduce our prepaid insurance by the corresponding amount of $133. Okay, transaction B says, at the end of the month, $600 worth of office supplies are still available. So if I look at here, my office supplies account here, it has $1,000 in it. What the problem is saying is that at the end, we had $600 worth of office supplies as an ending balance after we went out and counted all our office supplies. So the question then is, what kind of a journal entry do we have to make if we started with 1,000 and we ended up with 600? So if we do the math here, we said 1,000 minus 600, it's going to mean that we have to reduce this $1,000 balance by $400. In order to reduce this supplies account by $400, we're going to have to do a credit journal entry to office supplies for $400. So what we're going to do is we'll do the credit entry, office supplies, and that's for $400 as a credit. The debit side of the entry then is if we used up our office supplies asset, there should be an account called office supplies expense on the income statement to reflect the usage of the office supplies. Okay, the next journal entry says this month's depreciation on the computer equipment is $500. So we're going to recognize the expense called depreciation expense. So we're going to debit that. And that's in the amount of $500. Now we remember in chapter 2 we talked about that we're creating a brand new account called accumulated depreciation, which is a contra asset account. And the reason why we create this contra asset account is so that we can still show the cost of the asset, but we also want to show how much of it we've used up. This accumulated depreciation account is how much we've used up. Because it's sitting on the balance sheet, it's going to accumulate as long as we own the property. At the time that we dispose of the property, we'll have to get rid of both the equipment as well as the accumulated depreciation. Okay, the fourth adjustment that we're going to have to make, it says employees earned $420 of unpaid and unrecorded salaries for the month. So if we haven't paid them yet, we have a liability. And that liability is called salaries payable. But since we've also had the benefit of their work, we have to recognize that we have to pay our employees. So we're going to recognize an expense called salaries expense. Now that salaries expense is going to increase because we did get the benefit of their time. So we're going to increase the expense account by $420. However, we didn't pay them yet, so we're going to have to recognize that we have a payable. So we have a payable called salaries payable, and that's the amount of $420. The final adjustment that they have us make is that the company earned $1,750 of commissions that have not been billed at the end of the month. Even though we haven't billed for those commissions, we've earned it. If we've earned it, we need to recognize the revenue in the correct period. So when someone owes us money, we have what we call accounts receivable. So accounts receivable being an asset, we're going to increase it. So it's a debit of $1,750. On the other hand, since we earned it, we have to recognize the revenue. And so when we have to recognize the revenue, we have to increase a revenue account. And in our case here, we're going to credit commissions earned by the $1,750. Okay, so now we have our 4 adjusting journal entries that we have to make for this. So once again, let's go ahead and go over here, and I'm going to scroll my screen again so that we can see our T accounts. So now what we're going to do is we're going to debit insurance expense for $133. We're going to credit prepaid insurance for $133. We're going to go increase of office supplies expense over here for $400. And we're going to decrease office supplies, which is down here, by $400. We're going to debit depreciation expense, which is up here, for $500. Then we're going to increase accumulated depreciation for the computer equipment by $500. Then we're going to increase salaries expense over here by $420. We're going to increase the salaries payable, which is over here, for $420. And then we have to recognize accounts receivable of $1,750 and the commissions earned of $1,750. And now we've adjusted the books. Now what we could do is that we can go into all of our accounts and do our debits and credits to find out what the current balance is after the adjustments. So if I went here, I could add up all my debits and all my credits to find out what my cash balance was, my debits and credits to find out my receivables and so forth, so that I can create my adjusted trial balance, which then from my adjusted trial balance, I could create my financial statements. Now notice I try to group my T accounts so that you could kind of see on the screen here where from cash all the way down over here to retained earnings, those are my permanent accounts. And then my dividends, commissions earned, all the way over to these other expenses and the income summary are considered my temporary accounts. So after I created my financial statements and I'm satisfied that I got all my adjustments, it would be time to close the accounts. So what we can do then, and I won't do the journal entries because I don't have the space, but what I can show you here is that what we have to do to close the books. Because cash all the way through to retained earnings are considered permanent accounts, we're going to keep these accounts open. In other words, we're not going to zero out the accounts, but we do need to zero out the temporary accounts. And those temporary accounts are from dividends all the way to all our expenses, and we have to do it in the step-by-step approach. So step number one for closing out the books was to close out the revenue accounts. Our only revenue account in this problem here is commissions earned. So if I know that I have $8,000 and $1,750 on my income statement financial statements, I would have shown $9,750 worth of revenues called commissions earned. So I have a credit balance here of $9,750. So in order to zero this account, so it's zero at the end of the period, I need to do a debit journal entry of $9,750 into the commissions earned account. By doing that, this zeroes out this account for this month, the month of April, so that when I go in on May 1st, this account will have a zero balance so I can record just the commissions earned for the month of May. So if I do a debit entry here to zero it out, I need to do a credit entry to the income summary. So this income summary account now has a credit entry of $9,750, which corresponds to the zeroing out of the revenue accounts. Now what I now have to do is I have to step 2 says zero out the expense accounts. Notice every one of our expense accounts here have debit balances. So what we need to do is we need to zero out these accounts. So what I am going to do is I need to go to depreciation expense. If I have a debit balance of $500, I now need to do a credit of $500 to zero out depreciation. Now if I look at its salaries expense, I have two entries, one for $1,600 and the other for $420. I need to zero out the two debit entries with a credit entry. So I'm going to use $2,020 to zero that account out. I have to zero out the insurance expense of $133. I have to zero out the rent expense of $1,800. I have to zero out the supplies expense of $400. I'd have to zero out the repairs expense for $350. And I'd have to zero out the telephone account by $750. So now what I have to do is I have to put one single entry over here on the income summary side that totals all these adjustments that I made on the credit side for all my expenses. So I'm just going to do, because I'm using Excel, I'm going to go ahead and just create a formula here. And then I'm going to say, take this account over here. Oops, I didn't do this right, so let me try that again. We're going to say, create the formula and say, take this account right here, minus, oops, let me go back, plus this account right here, plus the $133, plus the $1,800, plus the $400, plus the $350, plus the $750. So what I've done here is I'm adding up the depreciation, the salaries, the insurance, the rent, the office supplies, the repairs, and telephone expenses. Take that total, I have $5,953. So this closing entry of $9,750 is my total revenues. This closing entry over here of $5,953 is my total expenses. The difference between the two of the $9,750 and the $5,953, or $3,797, is my net income. So if I take the difference between these two, so if I said $9,750 minus $5,953, my $3,797 is my net income number. So step number 3 says zero out the income summary. So if I zero out the income summary, what I'm going to do is I'm going to zero it out, and I have to post it over to retained earnings. So if I know this $3,797 is my debit entry, which will zero out this income summary account, and I now need to do an entry here of $3,797, which is going to increase my retained earnings. So that was step 3. Step number 4 says zero out your dividends account, because this is my last dividends. This is my last temporary account. So I have a $1,500 debit balance, so I have to credit $1,500 to get rid of it. And I'm going to decrease retained earnings by $1,500. Because remember, dividends decreases retained earnings. Now what I have here in the retained earnings account, if I had a beginning, this was a brand new company, but if I had a beginning balance plus my net income minus my dividends, the difference between these two accounts will be my ending retained earnings balance. This ending retained earnings balance will be the beginning balance for the next month as we roll over the month into the next period. Notice here in my temporary accounts here, dividends is now 0, revenues are 0, my expenses are 0, and my income summary is zeroed. So that's how we would do those journal entries and adjustments for adjusting for the transactions for the period, then the closing of the books. So now that I've given you how it was done, now you should be able to create your adjusted trial balance, should be able to create your financial statements, should be able to create your closing trial balance, and now you're all set for the next period. Let's move on to the next problem. This next problem, exercise 3.3, is a short little problem, but it kind of illustrates the issue about timing and making sure that you recognize revenues and expenses in the correct period. Exercise 3.3 says that Lopez Management has 5 part-time employees, each of whom earns $250 per day. In other words, if I take 250 times 5 workers, I have to recognize $1,250 every day for the work they do if they work a full day. They are normally paid on Fridays for work completed Monday through Friday. So therefore, what I've done here is I've kind of showed you that the payday is here on the 28th, and the next payday is on January 4th. The next week, the 5 employees work only 4 days because New Year's Day was an unpaid holiday. So this day here on January 1st is a holiday where they're not going to get paid. And then so what's going to happen, because they didn't work Saturday and Sunday and they got paid on Friday because their pay is from Monday through Friday, their payday is Friday, they're going to incur $1,250 for salaries on Monday. They're going to get 0 for Tuesday. They're going to get $1,250 for Wednesday, $1,250 for Thursday. They're going to get $1,250 for Friday. Now notice what we got here then is we need to make 2 journal entries. One journal entry to recognize the salaries expense for 1 year, and then for the salaries expense for the other year, plus that they made a payment here on Friday, January 4th. So the journal entry we have to first recognize is how much do we, even though we don't pay the employees here on Monday, December 31st, because we're on an accrual basis, we have to recognize that we accrue the salaries expense or the wages expense for this 1 day of work that was done on December 31st. So what we need to do is we need to make a journal entry where we recognize the wages expense for $1,250, and we have to recognize that we owe the money to our employees. So wages payable for $1,250. Okay, this journal entry would be recorded here in this prior year to recognize that this amount was being recorded. Now, when we come over here on January 4th, what we're going to do is we're going to pay the $5,000 in payroll for 4 days worth of work. So the cash is going to go down by $5,000, but what happens is we've already recognized the wages expense right here for this one day that's going to be paid here. So we have to decrease the wages payable because we're no longer going to owe it to our employees because we're going to make the payment on Friday for $1,250. Then we're going to have to recognize the wages expense for the 3 days worth of work, which is going to be $3,750. And then we're going to recognize that we did pay them. We're going to pay them $5,000 in cash to reduce the cash by $5,000. So this journal entry here, the debit wage expense, credit wages payable, is for 1 year. This adjustment here, or recognizing the payment plus the adjustment, would decrease the liability, increase the expense, decrease the cash. So that's the journal entries that we'd have to make for timing purposes. Okay, so let's go on to the next problem. Once again, here's a short problem to reinforce how we close the books. In exercise 3.6, it asks us to prepare the closing journal entries to close the books for this particular company, cruise company, and then to create a post-closing trial balance. Remember, the post-closing trial balance, all it is a listing of the accounts that have balances that have debit in the debit and credit columns. So in essence, after we close out the books, we should be able to show just the permanent accounts of the cash, supplies, prepaids, equipments, all the way down to retained earnings. And it should show our debits equal our credits. So let's go do the closing journal entries. Remember, step 1 of the closing journal entry was close out the revenue accounts. So we're going to close out the revenue account. So I go down here to revenues and I have service revenues with a credit balance. It's the only other account that we have here that's a revenue account. All these other accounts are assets, liabilities, equity, revenues, and expenses. So we have the revenue account. So if it has a credit balance, we're going to need to debit the account. So we're going to debit services revenue. In the amount of $44,000. we need then to credit income summary, which is our temporary account that we place our closing journal entries in. Okay, now step 2 says close out your expense accounts. So once again, I go over here and I take a look at all my expense accounts here from depreciation down to supplies. They all have debit balances, so we need to do a credit entry. So we're going to do credits to get rid of them. So we're going to credit depreciation. For $3,000. Then we're going to credit salaries in the amount of $22,000. Insurance in the amount of $2,500. Rent in the amount of $3,400. And supplies in the amount of $2,200. If I take the total of those, the balancing account income summary will be a debit. And so what I could do is just take the total of these numbers right here of 33,100. So if I did a T account here, I have a debit entry of 33,100, a credit entry of 44,000. So then step 3 says close out the income summary. To retained earnings. So if I've got 44,000 credit and I have 33,000 debit, the difference between the two is going to be a credit entry. So in order to get rid of the credit entry, I'm going to have to do a debit. So I'm going to debit income summary for the difference between the 44,000 and the 33,000. So I get 10,900. My balancing amount is into retained earnings, as it asks here to do. 10,900. So now I've updated retained earnings by 10,900. And the fourth step here, step number 4, is to close out the dividends to retained earnings. So if I look over here, my dividends account is $7,000. It's a debit. So I'm going to reduce retained earnings by $7,000. And I'm going to zero out my dividends account by $7,000. So what I've done is the 4 steps to close out all the temporary accounts. So what's happened now is that all these accounts from dividends on down are now 0. I've updated the retained earnings account, and now I can create my post-closing trial balance because none of these other temporary accounts should be on there. Okay? So hopefully that'll answer your questions on how to close out the books, and we're ready to move on to the next chapter.